And the next session will be about how to grow and sustain value for your business. So I'm going to hand over to Rotus. Rotus obviously is a presenter at Arise Business News, and he is going to introduce the panelists that are on. Over to you, Rotus.
All right, thank you so much, Tayo. I really appreciate being part of this great stuff. You guys at Nairametrics doing great work, informing the public about various aspects of of the finance world, and great topic today. So I'm joined by two great panelists that are with us. I'm going to introduce them one after the other. First, Dr. Ola Brown. Dr. Ola Brown is the founder of the Flying Doctors Healthcare Investment Company, FDHIC. They invest and operate across the African healthcare and wellness value chain in hospital, clinic construction and refurbishment, diagnostics and equipment, health facility management, pharmaceutical retail, and drug manufacturing, air ambulance services and logistics, and consulting and healthcare technology. Dr. Ola Brown, you are welcome. It's great to have you with us. We've also got Tunji Andrews. Actually, sorry, we should be joined in a moment by a couple of other panelists, but Tunji Andrews is also with us, founder of Awaba, a digital pension platform for self-employed Africans. He's a financial literacy advocate, macroeconomics thought leader, renowned media personality, also an award-winning media personality with various radio shows across the country, including Nigeria Info, Smooth FM, Classic FM, just to name a few. So it's great for you both to be with us. Lots of questions, lots of discussions to get into. First of all, I think the first question to start off with is why businesses should raise funding. So Dr. Ola Brown, I guess I'll start with you. Then Tunji, I'll have you chiming as well. Why should businesses raise funding? How do startups, I guess, Ola Brown, determine when the time is right to raise funding? Doctor.
So why and how? So it's really nice to be here. My name is Dr. Ola. I started my life as a medical physician and sort of transitioned into business. And while still operating my business, started investing. We've invested in over 20 companies, primarily in fintech and healthcare. So we're quite specific in terms of the sectors that we like to invest in. I've been both a GP and an LP in different funds. And one of the first companies we invested in was Paystack. We've also invested and exited other fintech companies. But our specialty is healthcare, where we invest in venture capital, we invest in PE. So I'm speaking from the venture capital perspective, but also the private equity perspective, where we've done take private transactions from the Nigerian Stock Exchange to private investors, for instance, so much larger transactions, and then obviously infrastructure transactions that are much larger than that, in the $30 to $50 million mark. So that's sort of the context from which I'm going to be speaking, both on the startup stage, but also infrastructure. Like you, I'm sure everybody saw the listing of IHS Towers, $6 billion, I think, valuation. That isn't a typical tech app-based company. It's more an infrastructure company. So I can speak to the infrastructure side as well as the private equity side. So just to give you a background and why sort of I'll be speaking from the perspective that I'll be speaking from, why and how are the two questions that you asked. So why do people raise funding? I think the primary reason why companies start to look for funding is because they believe that an infusion of capital can accelerate the scale of their business. They believe that there's something that's within their business, a bottleneck within their business, that an infusion of capital can accelerate and allow for exponential growth. And how do companies raise capital for their companies? There's a lot of different ways that companies raise capital for their companies. They do it through debts, typical bank debt. They do it through equity. They approach angels. They approach venture capital firms. Sometimes they crowdfund. So there's a whole number of different ways. And when we're talking about what investors want from a company, I think that that's a very, very broad topic. because it depends on a number of factors, including how you want to grow your company and your own personal goals. And the idea of the next unicorn and how to go about building the next unicorn is a really interesting perspective, because I feel like, Enyi will speak better than this. Enyi has helped to build 2 tech unicorns, but I think it's really important, sort of, since I'm the first person speaking, to set the context for this in terms of what that really means to the individual. So there are probably Igbo men in Anambra that have more cash than Enyi. So it has to, you have to think about, what do I really want and what is my reason for wanting to scale this business? Do I want cash in the bank? Do I want to build a legacy? Do I want impact? Do I want to eventually list my company? Do I want a good work-life balance? What's my age? What are my perspectives? And so that's why I'm going to talk about, sort of, do I want to own a large share? So would I want a more debt-focused strategy? Or do I want to own a smaller share of something that could potentially be much larger? And how much time do I want to spend working on this project before I perhaps go on to something else? So with that context, I'll probably hand it. I hope I've answered the questions why and how, but also answered it in a broad enough way to have sort of a wide-based discussion about the subject of building unicorns and the subject of raising money and the different ways that one can raise money.
Excellent stuff, Dr. Thank you so much. Really appreciate that. And yes, Iyi Boyeji is with us. So ladies and gentlemen, I'll be happy to introduce him right now. Iyi, great to have you. So Iyi, of course, Iyoluwa Samuel Boyeji, popularly known as Iyi, is the founder and general partner of the Future Africa. He's also the co-founder of Flutterwave. Everybody knows who Flutterwave is, a payments infrastructure company connecting Africa to the global economy with digital payments infrastructure that helps banks and businesses build more seamless and secure payments. And as Dr. Ola Brown said, Ian would be in a great position to talk about, since this is the theme, is the next unicorn, what investors want in the style. So Ian, thanks for joining us. I'll throw that same question to you. Why businesses, should raise funding, and how do startups determine when it's the right time, to raise funding, pre-seed, Series A, Series B? Ian, the floor is yours. You're welcome.
Thank you very much, and I apologize for joining a bit late. Forgive me, I had a meeting run a little over. I think that, first of all, when we say why should businesses raise money, I don't know a single business who doesn't need to raise money. Even if you're running a mom and pop shop, you actually have to raise money for your stock. So the question is, what kind of capital should you raise in? So should you be raising? And so venture capital, why should you raise venture capital? The big idea with venture capital is that, our business is, quite frankly, to back founders who are solving hard problems in large markets early. And the reason is because, innovation is one of those things where you do require a very clear strategy for engaging the market, right? Problems exist, but you need to be very tactical about being able to diffuse innovation that solves this problem. So I'll give you a practical example with the car. We think about the car as something we just buy, normal technology, but for its time, it was very early because people typically were using, horse and carriages, right? And then it only became more to use a car, when the innovation had been tested. If you had not been able to have the kind of capital that would allow you to invest deeply in something as mechanically complex as a car, right? You wouldn't, which could be a massive success or a massive failure. You wouldn't be able to have the innovation that is the car. You wouldn't be able to have so much today. So that is the job of venture capital. The job of venture capital is to invent new things that we didn't even know we needed. And because there is no validated market path for it, you can't go to your typical sources of funding for money. On the one hand, yes, maybe if you have the savings, you can put in some of your own money, but you can't go to a bank, for example, and ask for any cash. You can't go to there are many places you can go essentially to ask for that money, which is why venture capital exists. So if you are a founder who is solving a hard problem in a large market, you should be asking for venture capital. Other sources of capital won't even give you a second look.
Great stuff, Ian. Thank you so much. Excellent answer there, in depth. Also, we've got, of course, another panelist with us, Eloho Omame, who I'm going to bring in now. Eloho is the co-founder of First Check Africa, launched this year, 2021, building Africa's first female-first venture capital fund, investing exclusively in technology ventures led by women and diverse founders by focusing on Africa's vibrant community of ambitious, underestimated women in tech. Now, with over 15 years years spent in finance roles across investment banking and growth private equity, covering the UK, European, and African markets, she's an expert in capital structuring and fundraising for companies at all stages, including startups. Eloho, you are welcome. And I do want to ask you this: based on your experience, what type of investors should startups be looking to attract to their business, Eloho?
Okay. Thanks for having me. I think probably the most useful way to respond to this is to try and keep my answer consistent effectively with, I think, the brilliant framing that E gave us for sort of how to think about this, right? So on the basis that you're solving a complex problem, you're doing it in a large market, and you're treading a path that obviously is unproven, hence venture capital becomes the logical type of capital, or the logical source of capital for venture. I think a couple of things are important. It's important that you have first of all that founder investor fit. And what does that mean? It means that you're talking to a venture capitalist and you're not talking to a private equity fund, for example, because they focus on different stages of the market. Depending on the stage of your business. So for example, how early are you on sort of exploring this venture? You're also talking to funds that are stage appropriate, right? So you'll have some funds like ourselves at First Check Africa that focus, first of all, on teams that have at least women on them. So that's our first filtering factor. And the other is that we focus more on pre-seed stage startups. So what does that mean for us? It means startups that are anywhere from an idea sort of with pretty strong early customer validation up until, potentially an idea that has the product that's been launched in the market that has up to about $2,000 per month. And it's been launched within the last 6 months. Also, of course, looking for high growth. So if you're a company that fits that stage and you're at that pre-seed stage, for example, you have a female founder, First Check, stage fund. If you are, I can see somebody saying the volume is a bit low. I'm sorry, guys, I'm struggling a bit with my setup this morning. Is it really low? If it's really bad, I'll I don't know what else I'll do. Okay, let me try shouting.
It's not too low. You just fade. Yeah, exactly. You can shout. It's just fading. I mean, I can hear you, but yeah, it's fading in now. But go ahead.
Okay, I'm literally shouting, right? So, and then I'll try and fix it later. All right. So, I was saying, so there's a question of stage appropriateness, right? Let me practicalize it. A flutter wave. Yesterday we saw that flutter wave. Everyone is saying it's not better. I'm literally screaming. Yesterday or the day before, we saw some news that said that flutter wave was potentially going to raise, I believe it's Series D at this point now. The funds that will be invested in flutter wave at that stage, at that size rather, and at that stage, will be very different from the funds that might look at that very early validation startup that potentially a fund like First Check Africa. The other thing that I think is worth double clicking on when you talk about businesses that are building for unicorn scale, right, is also the mix of investors. So what will typically happen is you'll start with a bunch of early believers that probably look more like angel investors at your sort of pre-launch stage. And over time, an efficient way to potentially try and also make sure that you continue to have the capital available for you in future rounds is to try and get high quality global investors into your cap table over time. So I think, I guess in summary, what I'm saying is that the question of who the right investors are varies by stage. It also varies by things like ambition. And it's also a tactical question around ultimately, if I want to raise in the way that Flutter Wave has raised, it makes sense, for example, in my Series A, that I'm quite careful about the investors that I have on my cap table. And I start to sort of, project some of the indicators and the signifiers that'll mean that at Series B, when potentially the sources of capital need to come from outside of Africa for structural reasons, then I am attractive to that pool of investors.
Great stuff. Thank you so much, Elo. So yes, if I hear you correctly, it varies by stage. I also ambition as well. Thank you so much for that. Tunji Andrews, let me bring you in here. Tunji, the co-founder of Awaba. Tunji, what approach should one take as a startup founder when reaching out to investors? I mean, like, what's Awaba's experience so far? What are the successful models, Tunji?
Wow, I'm not sure there is any model that I know that has particularly worked. I think one of the things is just to, and you hear from previous founders who have raised capital, they tell you that they've probably pitched to maybe 100 investors, and you just have to keep going, especially when the business is still at the pre-seed level. There is always that temptation to personalize every no that you get. But I mean, one of the starting points is, the beautiful start that Dr. Ola gave when she was speaking about, the focus of her fund, and, it's sector focused in a particular area, and the person you might be speaking to might just not want to invest in the area that you've invested in. Some people do say things like, go to people who invested in previous companies that look like yours. That is also looking like a bad idea, because I mean, if the person already has a business that is exactly like yours, the person might not want to invest in your particular business. So for me, honestly, I'll say this. Every single person I pitched to said no, and all the angels that basically raised 200K pre-seed, which eventually went up to 250K, came to us. It was generally a basic issue of, we see what you're doing, we like what you're doing, want to be a part of it, and take our money. I didn't believe the first 50K, to be honest with you. I didn't even want to take that meeting, but I kept pitching. I kept, talking to people. I think I must have spoken to maybe 80 angels, and I got no's every single time. And I just understood that it was either that the business wasn't positioned right, or the business had not basically spelt out the value that we're trying to create. But you see, one of the things that was also very important for me was that every single no led me back to retweaking the model, trying to improve on how the business propositions itself. And one of the things I finally found out, and I think I found this out a bit late, is that you get to feel that what the two most important things in your business is the problem you're solving, and of course, team. It's said almost everywhere. What I've also realized that much more than the problem you're solving, it is the fact that the problem can scale significantly, because the investor at the end of the day is not a charity. They are trying to put in money into your business so that they can proverbially 10x the money. So if there isn't that potential for, at least on paper, for your business to 10x, it's very, very difficult for you to be able to raise that funding. So I think that the thing is just you have to kiss a lot of frogs to be able to get the prince. But the fact is, just don't stop. There's a lot of resilience that is in that place, especially at the pre-seed level. As it goes up, you start to have, you validated, you have the proof, the business now looks a bit more structured. You would find more institutional investors who will be willing to come and lead your rounds as you go into the future. But yes, the starting point is always very, very, very difficult.
Thank you so much, Tunji Andrews. So the message there, persistence, believe in your product. You also talked about the business proposition. Dr. Ola Brown, let me come back to you. Tunji was talking about business structure and what investors want to see. Dr. Ola Brown, my question for you, how does a startup founder determine what the commercial value is of their business before reaching out to investors? Dr. Brown, your take, please.
So the conversation has been primarily around venture capital and early stage startups. So I will speak to that rather than how valuation is done in the private equity world or sort of larger businesses. So in terms of valuation, some people say it's a dark art. Some people say that it's 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 by the power of God. But I think the valuations are generally like people generally come to their valuations. If there's a business doing what you are doing in the market, then it's good to look at what they were kind of valued at and what their metrics were when they were valued at that. So a lot of venture capital firms look at, okay, this is the type of, in this sector, this is the type of valuations that are these are the sorts of valuations that similar companies are getting in this sector. For example, because I invest in fintech and healthcare, they're very different sectors. And the valuation of a healthcare company in the healthcare sector right now with a certain revenue may be different from a fintech with a certain revenue and certain metrics in the same industry. Another thing that people look at is market size. And it depends on the investor that you're talking to. Some venture capital firms are very team orientated and look at the team. Some of them are very product orientated and will audit your code and look at the product specifically. And some are very market size orientated, and I'm very, very market size orientated. If you look at my writings, if you followed my work, then I'm obsessed with the size of the market over everything else. And I would prefer to have a team that is not that great in a big market than to have the most fantastic team in a market that just isn't moving forward. Because if you're in a bad market, then you can have the best team, but you'll just be struggling to stay afloat. And I'm sure there's lots of examples that you can even think of in the Nigerian context, for instance, in the banking industry, for instance, where it's not about the person's financial knowledge. A lot of the biggest financial institutions in Nigeria, they went into banking at the right time and they were able to get a banking license. Or it wasn't necessarily about the person themselves, but more about the fact that just banking was blowing up at the time and they could get a license. And some people could not get a license, even though they were more intelligent. So I think that the market for me is, personally is a huge consideration. But for some other firms, it might be the product, it might be the team. But I place emphasis on the market and then the team and then the product. So valuation is typically based on number one, what sector you're in and what kind of valuations people in your sector have been attracting. Number two, the size of the markets. I think is a big thing where you can say that, okay, this is the market size, this is the number of customers, this is the addressable market, this is the type of revenue, and also the business model, I think is important. So any business that you can build that has recurring revenue is likely to attract a stronger valuation. So that's why, software as a service, at least in America, is such an attractive business model because you have loyal subscribers that even sometimes forget to unsubscribe and they'll continue paying the same amount of money over and over again. So that's something else that investors look at, like the structure of the business, the way money flows through the business. So yeah, market size, sector, what other people have raised and the valuations in those things, and then your team as well. Second-time founders find it easier to raise capital because investors are more likely to bet on them. Because it's believed that they have the experience they've raised before. And even if you look at statistics, I think that sometimes, numbers can be different from perception. In the perception world, everybody that is raising money and building unicorns and building successful companies is like 21. But actually in the real world, the people that build the most profitable companies are over 40. If you look at the numbers, and that's, or the most successful startups are usually over 40. And that's because they have the network, they have, the experience. And they tend to have because they've been in a particular industry for a long time, they build for that particular industry. So those are the things that affect valuation. But what exact valuation that you get really is the price that an investor is willing to pay for your business at the end of the day. And that's your valuation. If somebody is willing to invest at that price, then that is your valuation.
Thank you so much. Very, very in-depth there, Dr. Ola Brown. E, please let me bring you in. So lately on Twitter, red flags have been trending. And Twitter put out a tweet saying, quoting someone saying, "I'm not on Twitter, red flags." And then everybody else was piling in with different red flags back and forth. So it's been an interesting, funny, trending thing we've seen on social media. So speaking of red flags, E, I wanted to ask you, what are the red flags from investors and startups that folks should be aware of in your view? You're on mute, Ian. Sorry, you have to unmute yourself.
Sorry about that. I'm actually a very different kind of investor. You know, so I don't think in terms of red flags. I mean, I think in terms of green flags. So because, you know, the problem with investing is like, there's no way to really predict, you know, if you think about it in terms of red flags, you know, you very easily miss, you know, the fantastic thing, right? Yeah. So I think for me, I'm really focused on identifying founders that are mission driven. They're really, really passionate about a problem. They want to solve it. I care a lot about founders that bring data to the table, particularly data that other people may have disregarded or is non-obvious to other people. I feel like I'm learning when I meet these founders. So that's really important to me. I really like founders who design for where the customer is. So they're not highfalutin. It must be an app. The customer must be smart. They're like, look, this is where the customer is. So we're going to go to them with the product. You know what I mean? And then, you know, look, I love customers that can, I love founders that can sell. They have the ability to convince people to do things for them, to partner with them. They have the ability to build trust with people. So those are really kind of what I look for. Those are my green flags.
Sorry, but on the subject of red flags, I'm just going to point out something that somebody once said about you, Inyi. Somebody that backed Inyi once said that he looked at how Inyi had treated his previous investors. And Inyi had always been fair. Even if a venture had not gone well, Inyi had always been fair to his previous investors. So I would say probably a red flag to most investors is if you didn't treat your previous investors well. So for example, there's been situations within the venture capital angel investment industry where, you know, somebody has invested, they've invested the whole trans, and then the person has taken the money and relocated. They now come again in a few years' time, and they didn't do any business, so they now come again in a few years' time and start saying they're doing another startup. When you do a DD on that person, a red flag will come up.
Why do I always feel I know? Why do I always feel I know who Doc is talking about every time she says this?
I'm just saying that, like, somebody that I really respect said, you know, one of the main reasons why he backed me is because he is always very, very fair in terms of the way that he treats his investors. So I think it's important to just put that out there, that even if the thing is not going well, even if your company is falling apart, communicate respectfully and let the people know that this is what's happening. As in, you know, no venture capitalist puts money into your company thinking that you're going to be the next Amazon and it's a 100% chance. We're also taking a bet, but what we don't want to do is learn that you relocated to Germany and used the money to fund your master's.
Thank you, Dr. Bradley. And Ian is always, I follow Ian on Twitter. He's always pushing for positivity. So I get why Ian would pivot from red flags to green flags. So Ian, thank you for your answer. Dr. Brown, does anyone, Eloho, I'm coming to you. Do you want to jump in on the red flag? Maybe we should just throw this out to everybody. Eloho, do you want to jump in on the red flag conversation, or, because I was, yeah, go ahead. Do you want to?
Sorry,
Eloho?
I can try. The second thing you said, I think about green flags. Somehow I said to myself, this question is going to make it way back. So I was not a fan. I was thinking, gosh, you just answered the question. But no, I actually think your question was, what are green flags from the founder's perspective? Sorry, red flags from the founder's perspective, right? So I do love sort of his framing around kind of from the investor perspective, looking for the ways in which things can go right, as opposed to focusing on all of the reasons why something might go wrong here. So I align there. I think from a founder's perspective, what might some investor red flags look like? I'll call them red flags because you're forcing me to call them red flags. But I think I think it's important to look for investors that can be additive to your journey, whilst also being respectful to the fact that, or of the fact that you're the founder here ultimately. So red flags to me, specific to our context, are things like, and you know, it's one of these things where we all hear the anecdotes and no one really ever wants to kind of say it with their full chest. But it's when you see things like my first red flag is an unreasonable ask around ownership of the company. I think if you're raising, for example, at the pre-seed stage, it's important that at the different stages, it's important to sort of have an appetite or understand that what you're selling is equity in your business, you're selling vision, you're saying somebody come on that journey, and you have to give up some dilution to do that. But sometimes we see unreasonable amounts of dilution, even by the time that we come in as First Check Africa, which is super early. So you see a founding team that has raised, I don't know. And again, remember the journey is long, you're building a unicorn, but they've raised 100K and they've seeded 30%, 40% of the equity in their business. Another red flag that I've seen, and I guess it becomes a red flag one, unfortunately, once the founder has already fallen prey to it. But another one that I've seen is some investors will give you an amount of capital that looks fairly significant, but they will put restrictions on your ability to apply that capital based on your own experience and in your own discretion to grow your business. So I've seen angel investors who will say things like, this capital can only be used for you to hire an accounting firm and to hire a law firm. It has to be Big Four. And that really ultimately hamstrings a founder, and also, to my mind, indicates that that investor actually doesn't really understand the stage of business that they're investing in. Another red flag issue for me is investors, the flip side of Dr. Ola's point, investors who have not treated their founders historically well. So I think one thing that is important is that founders talk to other people who have these capital investors. What was your experience? What were they like when things were going well? What did they do when things did not go so well? Investors who are not respectful of the founders and who perhaps then expect to have, I think, an undue influence ultimately because how a startup is run is another red flag issue for me. And I think all of that just culminates probably, if I were to put it under a broad bucket, it's a little bit sort of integrity, it's a little bit investor experience. There are a lot of people that have a lot of money, but they don't necessarily have a lot of experience investing in startups. And therefore, some of the requests don't seem unreasonable to them. Those are probably the red flags from a founder perspective that occurred to me immediately. I wouldn't count red flag issues, things like, you approach an investor who is, focuses on the later stage startup. I think there, that just comes down to, frankly, your own sort of lack of diligence around, is this a stage appropriate investor? But, assuming all the other boxes are ticked, so they're stage appropriate, they invest in Africa, they invest in your sector, etc. Those are some of the early red flag issues that I would guide founders towards.
Thank you, Eloha. All right, Tunji, we've thrown it to everybody. So Tunji, please chime in. What's your take on the whole red, and I guess we're throwing green flags as well if you want. Tunji, go ahead.
So for me, it had to be, and I mean, we're seeing a lot of investor attention all of a sudden now, but there are a few things. There are just a few things. The space that we are in is a lot of heavy lifting. If I'm going to be very straight about it, it's a lot of heavy lifting, and you just have to understand the concept of what we're building, and you have to understand it with the concept of similar companies who have built similar companies across the African continent. Forget the African continent, built it across the world, period. It's heavy lifting. So for me, there has to be some level of understanding of what we're doing on the investor side. At the pre-seed, I mean, you take money wherever you get the money level, but as you start to grow, you start to see that one of the things that is important to you is that the person who is looking to invest your money in your business is knowledgeable about the business that they're investing in. Also, the second thing, and I think this is just some of the things that we've been able to get some view on being part of Techstars, is the kind of investors that come to speak to you. So what is happening across the world right now is that there's a lot of illicit money flowing across the world that is looking to find its way into startups. You as a Nigerian person who doesn't have a lot of access across the world wouldn't know. And also there are some businesses, so there are some VCs across the world who historically they are not very good with their with the businesses they invest in. So you need some sort of place where you can plug in those names to find out and do your serious DD on those people. At the pre-seed stage, what Eloha spoke about, 100K for 30%, It's very real. Somebody offered us 50K for 40% of our bar at the time when we're raising pre-seed. I didn't know whether to fight or to to insult the person, but you know, it's one of the it's one of those things. And it was going to come in trenches. That was even worse spot. It was going to come. Well, but you know, I honestly think one of the things you can do, one of the things that helps the most is whenever anybody's trying to put money into your business, ask around. You know, have people like Ian close to you, have people like Doc close to you. You know, just ask around. Somebody would know something about them enough. Because the truth about it is that, and one of the things I've seen about the relationship with the people who've invested in our bar is that the relationship you have with them is a lot more critical than the money they put into your business. You know, there's one of our investors who's like my motivator. You know, most of the time when we hit one, you know, small rock, and I call the guy and he's like, you know, he's by the time I leave talking with him, you know, we're ready to take on the world again, and I'm really grateful for that person. You just have to find the people who are very useful to you. Money is always great, but you start to realize the bigger you get, that money is not as useful or as important as a lot of things. There are some investors that would, you know, help your repeat rounds. There are just some people that once they invest in you, boom, it's as good as done if you continue to hit the milestone. So red flags would be, you know, especially when you're going into the seed and the Series A round, would be the how does the person know my business? Is this person just doing a vanity investment here? Is the person asking for too much? Does the person want too much control? I mean, well, too much control is unreasonable control, because there's some level of control in the whole conversation. But generally, it's about the disposition and the relationship for me. If the person is not going to offer us more than the money, then I mean, there's other money elsewhere on the table.
Thank you so much for that, Tunji Andrew. So I think we want to pivot now to a second set of questions. First set, we're talking about how to raise funding for the business and things around that. Now I want to talk about business growth and sustaining value. So Tunji, thank you for that. Ian, let me come back to you. So you, of course, as we all know, you're able to start 2 unicorns in your lifetime. Ian, what would you say, Ian, are standout metrics that determine a business is doing well? Ian, what metrics would you place that on?
I mean, well, first of all, you know, just to qualify that, I think the teams at those companies are the ones who made them unicorns. I just had the unfortunate luck of starting them and building them, but the teams are the ones doing the work. But I think the biggest metrics that I look at when we're building, every business is different, actually. So you typically will have one core North Star metric. For us at Flutterwave, it was transactions. So how much in transactions would you be able to, how many transactions could you process at any given time? Because that drove all your other revenue metrics. For Andela, it was earnings per engineer. So how much could an engineer make? Because then those drove all the other metrics. So you typically have a core North Star metric that would differ by business. But I mean, every business's core metric is different. But obviously, there's a few ones that cut across. I mean, as currently, I'm a venture capitalist, so we track a few across board. So we're looking at how many people have you hired. We're looking obviously at revenue and unit economics, specifically customer acquisition costs or cost of goods sold as compared to lifetime value for the customer. We're looking specifically at revenue per employee, and we're also taking a very close look revenue per user. If you're that kind of business, we're taking a close look at valuation and how your valuation tracks over a period of time. And there are a couple other metrics that we use to measure how things are going. But the core metrics are really specific to each company and their situation.
Thank you so much for that, Ian. Thank you. I really appreciate it. Dr. Ola Brown, let me come to you. Scalability, and we all, when it comes to startups, we talk a lot about scalability and how integral it is, Dr. Ola Brown, to investors to measure them. How do investors measure a startup scalability post-funding, in your view, as far as determining its value?
So for us, I mean, like I said, we're sector specific, and we're sector specific for a purpose. My network in healthcare is probably one of the best in West Africa. I've started and founded one of the biggest healthcare emergency companies in West Africa, and I moved into investing in healthcare, both from the infrastructure, private equity, and VC. So in terms of scalability, when we're looking at a company, we don't necessarily look at how well it can scale in a market that we don't know. We look at the scalability in a industry or in an area that we know we can immediately start introducing the startups to the right customers. So we know probably when we're at the point that we're investing, we probably know who is going to do the Series A. So we probably know that, okay, once we reach this and we can start introducing, we know all the healthcare specific investors. So we know that, okay, after a certain point, we can start introducing them to the follow-on investors that invest in this space. And this is what these people are looking for. We know the European investors that invest in healthcare. We know the American investors that invest in healthcare. We know the ones in Africa, and we know what they're looking for. We know what their specialities are. And we also know the kind of customers. So when we're investing immediately, we know, okay, who are the people that are going to, the customers that are going to take this company to the next level. And we start building those strategic partnerships as soon as we invest. So when I'm looking at a company that I'm investing in, I'm looking at how they want to grow. I'm listening to their vision, and I'm saying, look, do you see yourself working with these people? Even within the portfolio, I mean, we're invested in every area, probably across the healthcare value chain, as well as the underlying finance under the fintechs that help that healthcare value chain to work. So we invest in healthcare and fintech. And immediately we're investing in a company, we're saying, can you work with our hospitals? Can you work with our diagnostic centers? Can we take you into North Africa? Can we take you into South Africa? Is this something that you want to scale into Europe? These are the customers that we'll be able to introduce you to there. So our portfolio management strategy is primarily based on helping the company scale through customer acquisition and helping them to grow their revenues.
Thank you so much for that, Dr. Ola Brown. Great stuff. And for our participants, there's a Q&A box there. You're seeing the questions. Throw them in, and we will get to as many of them as possible for our panelists. Eloho, let me bring you back in. As under as far as the question of, or rather, talking about business growth and sustaining value, Eloho, what are the best money management strategies after securing funding, in your view, Eloho?
So money management strategy, I guess, for your startup founders.
Yes.
I point to a couple of things. So we've referenced already in this conversation, the importance of being sort of data-driven and metric-driven, and specifically thinking about things like unit economics and growth margins. So what does that mean? It means that best in class, every dollar of capital that a startup founder is projecting to spend or planning to spend, he or she knows ultimately how that money will be spent and what the return that's going to generate in the business. Founders that have that level of specificity obviously tend to just operate their startups a bit more efficiently. How you measure things like that depends on the particular sector that the business is in, whether it's a consumer-facing business, whether it's a B2B business, but ultimately being super metric driven, understanding the basic kind of unit of profitability that your business runs on, and then ultimately, thinking of capital as a tool in that way is a really, really smart way to manage capital. Another good way to think about managing capital is in your fundraising journey, right? So we're talking again about a journey to building a unicorn. Now we've talked about raising, and that necessarily or tends to imply raising successive rounds of capital, right? And then, suffering a bit of dilution as you go at each point. So what does that mean? It means that from a money management perspective, it means that, you know, you're perhaps pre-seed, you're raising, let's say 250K, right? And then, you know, at some point you're going to raise the next round, which is usually a seed round. At some point you're going to raise a Series A, Series B. How is each amount of capital efficient, such that you're able to generate as much potential growth from that capital, so that you're able to display the kinds of metrics that mean that the next round of capital gets raised at a super efficient valuation for you as a founder. So you're taking less dilution, you're potentially, you know, being super efficient with how you manage the capital in the meantime, and, you know, you're potentially then raising the next round maybe faster, but you're also doing it at a set of numbers and metrics that means that it is just super efficient for you as a founder. I think the third thing is less about the cash itself, and it's more about disciplines and practices around how you think about operating your startup, right? So one super effective and I think overlooked tool is things like, especially for early stage founders, but it's things like getting into a rhythm of reporting your startup, but doing it in a super metric driven way and in a super thoughtful way. So every month you sit down and you literally write a memo to your investors, right? And you say, here's what we've done this month. And if you push yourself again to always link back to that North Star metric, always link back to the decisions that you made, why you made them, and how it benefits the business in the short and potential and the long term. If you always push yourself to again convey to your investors how you're thinking about kind of, you know, how much cash I have left in the bank, where my, you know, what kind of metrics I need to hit next. That discipline ultimately gets you to a point where you're super conscious about every dollar that you spend. You're super efficient about it, and of course, you're also building goodwill with your investors. So those would be the three that occur to me.
Thank you so much for that, Eloho. Tunji, let me come to you now. Tunji, what are integral business processes and management structures that need to be practiced by startups once, you know, funding has been raised? In your, just to piggyback on what Eloho has talked about, Tunji, what are your thoughts?
I think usually the first set of things you want to do is the right kind of hires. And when I mean right kind of hires, as the founder of the business, you're like the chief marketing person. You're the person who goes out to get a lot of the dirty jobs done at the start. You will not have a lot of time to, you know, accurately put the accounts in place. You won't have all the time to be able to accurately put all the operations into proper metrics. So you need some very strategic hires. I'm not talking about, you know, just go crazy hiring people, but you need some very, very, very key people. So when you're talking accounts now, for instance, you don't necessarily, it's not, you should be looking for someone who can, you know, do these double, what do they call that thing again? The single column cash book kind of thing. It has to be somebody who properly understands finance to be able to project your business and, you know, give it, especially if you are not that person, if you don't understand finance that deeply, because a lot of founders really do not. So you need somebody in-house who can, or at least you need to outsource or give that some critical thought. But the general thought now is, while you're, you know, showing a lot of gusto, showing a lot of excitement, showing a lot of aggressiveness towards the market, you now have to also, you know, step back a bit, because money finishes. There are massive founders across the world who have blown huge amounts of cash. I don't know how much you raised that would not be able to finish. So you now need to, you know, like Eloho was talking about, the efficient use of the cash. You need to, you know, be able to prove to yourself on a consistent basis that every single dollar spent, you know, has some, you know, major return for the business in terms of specific growth. So with every quarter, one of the things we do at our bar is set specific goals for ourselves outside the usual North Star metrics, you know, things that we want to be able
All right, we may have, is everyone still with us? I think we may have, you may have frozen out a bit there.
I'm with you. This is Eloho. Can I just, whilst we wait for Tunji,
Yeah, go right ahead. Go ahead.
So I think another thing that occurred to me as Tunji was speaking is, I think another thing that we see that make us a bit uncomfortable from a cash flow management, capital efficiency standpoint when we founders is you'll see some founders that will say, the first thing I want to do with this capital is I want to hire a lot of people and I want to pump a bunch of it into marketing spend at the very early stages. And, red flag, green flag, for us, that's a bit of a red flag. Because usually we tend to kind of default to this idea that we have to buy customers, which is effectively what marketing is, right? And often there are tactics, like growth tactics, and that means zero spend, such that you can prove ultimately that there is an end level customer valuation and there's an end level customer pull, right? That doesn't involve you effectively persuading customers to try your product and potentially kind of stay on the platform depending on what you're building by virtue of the fact that you spent $1 to acquire them and spent some amount of money to acquire them. So that's another good way of sort of thinking about, I guess, capital efficiency more conceptually and more broadly is or cash flow management is, do I really need to spend to do this thing? Or do I just really need to get really good at doing something as a founder? It brings me to the second point of my question, or my second point I wanted to make, which relates a bit to something Tunji was saying. I have a slightly different view around this idea that you should immediately go out and hire people who can do things better than you. I think there are a bunch of things that founders just need to, if you're serious about being a unicorn founder, I think there's a bunch of things you need to figure, I can't do these things well, and I need to get good at it. You can't be a founder that sits in a meeting with an investor and when they ask you a more than surface level question on your numbers, you say, hold on, let me get my CFO. It's a little bit ridiculous. It's important that you understand what the core drivers of your business are. You understand, again, every level of capital spend that you're making online. So you can talk to me about, you referenced your customer acquisition cost, but you also reference your customer lifetime value. So you're selling a B2C product of some kind, and you know that every time I spend $1 to acquire this customer online, I expect to hold that customer for, you make assumptions initially and you validate it over time, but I expect that customer is going to be with me for a 3-year period on average, right? That's the customer's life cycle. And I think that these are the products I can sell to them on the journey. Here's how much I need, how much I'm going to make. And so you can prove to yourself that that dollar of spend is efficient. And I think both of those things become important. And then what does that mean? It means the founder probably has to be, until you get to a point where you can hire a big team that will be better than you, you have to understand that being able to sell is an important skill to your investors, but also sell your product. Being able to understand the capital efficiency and how you run your product is an important skill. Saying to yourself, I'm going to hire someone that can do it, I don't know. And that's not to say, of course, you have to be a chartered accountant, but the fundamental underlying sort of numbers around business, how it operates, how it is efficient, is something that I would always look to the founder for, and I would be deeply uncomfortable if the founder referred me to somebody else. I don't expect you to be an engineer on the tech side. That's sometimes why you have a co-founder or you hire somebody who is a product specialist or an engineering specialist. But I do think that, at a high level, again, you should have a level of comfort with the technology. You may not have it the second you start building a startup. Better go and understand what your technology does. You may not be able to edit the code, but what does your technology do? What is the roadmap on the technology side? What core features are you bringing in when? What are the triggers that would mean that you do that? I don't think that it's some of those things. I think sometimes we meet too many founders that make this assumption, I will hire. And if you do that too early, it's actually a bit of a red flag issue.
Okay, well, I would love to get everybody else's thoughts on this. Aloha, thank you. So, piggybacking off of what Tunji said on hiring, Aloha, Ian, let me bring you in. Based on what Aloha has said, what's your take on, the to hire once the funding comes in? What do you make of it, Ian?
I think I agree with some of what Elo has said, but I also think that every founder comes with different skills, and founders have to be able to be honest about their strengths and lean into their strengths, and then be able to work with or hire co-founders or counterparties that can help them on their weaknesses. So I think what a lot of founders tend to do, and I've done this myself, is kind of shape themselves into the archetype of a CEO that they've read about in the newspaper or in novels or something. But that model rarely works in my experience. What matters is whether you can surround yourself with a team that can cover your shortfalls, because you're probably not going to be able to get better faster than you can get better at something you're really bad at, faster than you can get better at something you're really good at. So my advice, but I think one of the things founders often miss out when they raise capital is the need for strategy, right? A lot of founders, when they raise capital, or even before they raise capital, just kind of ask for an amount of money or get an amount of money and look at it like a windfall. But they haven't really thought through, particularly where they need to invest that capital in order to be able to see a return that lands them their next round of funding or profitability, depending on what their goal is. What I ask founders to do is to think strategically about how they want to deploy the capital. What kind of infrastructure do they want to invest in? What kind of products are they able to now sell? What kind of moats are they able to build? Because you've raised capital, but everybody else who read that press release isn't just going to sleep. They're going to come for you. How are you going to protect your business from intense competition that follows? And it might require you sometimes to do what we call raising the moat. So you might need to explore strategies that may seem in the short term foolish, but over the long term do raise the barrier to entry for your business. These are some of the strategy issues that have to be discussed. And you have to now you have the resources, you have to hire people who care a lot about the minutiae of how that strategy can be implemented. So that's what I advise founders to do when they raise capital.
Great stuff. Dr. Olabran, I have to bring you in as well to comment on what has been said so far. Still along the lines of the push to hiring and piggybacking off Ian, what Ian has just said, Doctor.
So I've invested in a lot of different kinds of founders, and even within the healthcare space, there's pharmaceutical manufacturing, there's pharmaceutical distribution, there's lending to healthcare, there's software as a service. And I think it's important to also listen to the founders and understand their own goals and the metrics. In private equity, we're majority stakeholders, so we can actually, be a bit more influential in the business. But in venture capital, you probably own like less than 10% of the business. So I think it's very important to listen to where the founder wants to move to and, advise. But I'm not 100% on, I think that in terms of hiring, the most important thing as a founder is to be very brutally self-aware. I've built companies and I know what I don't do well. And some people are not good at knowing what they don't do well. So I think it's important to be brutally self-aware and say that, look, this thing that I want to do, I'm going to need this skill set to help me to achieve it. And if I don't hire in this set of skill set, I will not achieve the velocity in the business that I want to achieve. So I think number one is self-awareness. And then I would move to number two being what most people have echoed is that ability to sell, that ability to persuade people, because more than just persuading investors, you're going to have to persuade people to leave big companies to come and work for you. It's going to be difficult now. It's almost like you're ruining the person's life, telling the person that, oh, you are in this big company now, you're at PwC or you're at McKinsey, come and work for my small company for half of the pay, and I'll give you equity that they're not even sure of. So being able to persuade people and being able to sell your vision is really, really important. And I think that's a second quality. But you're going to need to have, on that journey, you're going to need to invest in the best possible talent that you can, particularly if you're heading for that unicorn status, where my definition of entrepreneurship is trying to achieve something that you could never do by yourself, because it becomes not about you. It really, really becomes about the team that you surround yourself with. So then what to do with the money was your main question. So that really depends on the business. For some, they'll be focusing on the product. For some, they'll be focusing on hiring. For some, it could be marketing. If your metric is acquired customers only, and that's what the people in the next round are going to be looking at, like how many customers do you have that are paying? And it doesn't, some next round investors, and that's why it's really important to talk to the people that are investing in your current rounds, because they will have a role in shaping the story for the next round. So a lot of the companies that we've invested in now are coming to their Series A, and we're having these conversations like, what's going to be the story? What's going to be the metric? What's going to be the focus of those conversations that we're having with the follow-on investors? And depending on, what that conversation is, you might need to do some marketing. You might need to invest in strategic partnerships, because sometimes one partnership can unlock 1,000 new customers, and then you're not spending on marketing. You're just spending on building that relationship that unlocks a level of exponential growth. For some people, they are presenting, that are raising their Series A now, they're presenting a Pan-African story. So that means they're investing in other markets, even though their market in Nigeria might not necessarily be that deep. That's the story that the founder wants to present. That's the story that the investors that they're targeting want to hear. So they might have to spend on expansion. But what I would say is talent is important, and the strategy, where you are going, and the story that you're telling for the next round is important as well. And the metrics that you really want to build that story around, I think are important. And that kind of guides where you put the dollars that you raise, and how efficiently you use the dollars you raise depend on your recording of metrics. And I was so glad when Eloha, I'd written reporting in capital letters here. The reporting is not necessarily for your investors, it's for you. Accountability is actually something that is so valuable to me. I mean, I account for the way that I've spent my day every day, and I'm not even accounting to anybody, but I'm accounting to myself. So write your reports, not necessarily for your investors. Your investors will help you raise money, and they'll help you get strategic partnerships. But write it more for yourself, because you will even know what to ask for from your investors if you get the discipline of being accountable and writing the report. And it also helps the team as well to align, because when they see those reports, or you build a culture of reporting, then it guides how your team also report to you and their levels of accountability as well.
Great stuff. Thank you all for your very insight. If I can quote Thanos from one of my favorite movies, Infinity War, this panel is perfectly balanced, as all things should be. Tunji, let me come back to you. I really want to get everybody's take on this, actually. Incubator and accelerator programs. Tunji, how important? I'm going back to the funding. I mean, we're going to pivot back and forth between funding and then business growth and sustaining value. Dr. Ola Brown, thank you so much for that, your last comment there, last answer. But Tunji, back to you. I think we lost you a little bit with your answer. That's why Law stepped in. But Tunji, how important are incubator and accelerator programs in raising funding for businesses? And what do you make of incubator and accelerator programs, I guess, here on the African continent? And I'll throw this to everybody, but Tunji, go ahead.
Plenty questions there. So I would only speak to the one I had the opportunity to be a part of, Techstars. And honestly, this was just an advice from one of our advisors who said, you know what, why not try out YC or Techstars? And I mean, it goes back to a little about what Dr. Ola said about being self-aware. I just, looked at the YC model, and of course, YC seems to be the bigger dog, but I just didn't think I could thrive in the YC environment generally because of the large, gathering. I just don't thrive very well in such a learning environment. So Techstars was really built for me and built for my team. So we went towards Techstars. Now, the announcement did a lot of good for us. I would not lie. The announcement did a lot of it paid in. A lot of people started to pay us attention. Some angels that had promised us cash, finally issued the checks after the announcements were made. So I can tell you that, yes, it did help. But honestly, being a part of Techstars has been massive. And from people who have, gone through it are telling me that, this is just the beginning. First of all, we went through something called Mental Madness, where we had to pitch to 100 different investors. And what you realize is that from the beginning to the end of that, your model starts to evolve gradually. You start to, get different perspectives to your business, not from the perspective of you're looking for money, but people just want to hear and give their own feedback. Some of the feedback is useless, but a lot of them is critically useful for your business also, and you tend to grow over time. The fantastic thing is, I honestly think if you do not have a trust fund somewhere where you don't have your own a lot of money that you can invest into your business, and you probably are coming to the end of your own particular savings that you need to still continue to grow the business with some capital from outside. I think going to an accelerator would be very, very good business. Not only does it do a lot for you in terms of access to resources. I mean, some of the credits that we've gotten from things like Amazon, Google credits, the text message service provider that we have. I mean, I'm just realizing we have 10K here, 10K there to be able to do things I would have used our own money to be able to do initially. It's a lot of help, and you have people who are hands-on from different industries just ready to help you, who are basically paid to help you through this process. So I think it's something people should consider, but I say this with a bit of a caveat. You obviously trade equity for getting into these places. The Techstars, you trade 20K for 6% of your business. It still hurts a bit, but I mean, it is what it is. So you have to really look at it well if it fits what you're trying to do. A lot of people end up losing as much as 15% by the time they've gone through such an accelerator. And it can be heavy really on your business, especially that 20K. I think YC does about, I don't know if it's 25K for the same figure, but it can be heavy. It can be heavy on the equity side. And you just have to look at the flip side. Is this worth it for where we are? Can this significantly be useful to springboard us to the next level? For me and for our bar, I think it's been great. I think it's been very helpful, but I don't know about other businesses. I think you just have to really know what is good for yours. I think Rhodas has dropped off. Taya, would you step in?
All right, thanks a lot. Can you hear me? Hello, Tunji.
I think he's back.
Yeah, he's back.
He's muted though. Rhodas, you're still muted. We can't hear you.
Okay, can you hear me now?
Perfect.
Okay. Sorry about that, but Tunji, I lost me in internet. This country, I don't know where I got caught off. I think Tunji was just in the middle of talking about Techstars, and actually, I'm not sure where I got it, but go right ahead. I'm not sure what was going next or accelerator was Tunji or Eloho, but please carry on.
Tunji if I can help, Tunji had finished the answer to your question. Should I summarize, Tunji, for you? I can.
No, just keep going. I'll catch up. If you're still on accelerators and incubators, go right ahead, please.
So you want me to talk about that? Okay. So yeah, I mean, I love the perspective Tunji gave, which is a very personal one on Awaba's journey with Techstars. And I think obviously I'm not a founder myself, so I haven't been through an accelerator. Or I guess I haven't even considered it. But the way I think about accelerators as an investor, and often because we're investing so early in the companies that we're looking at, we're at the point where we're having conversations actually with our founders about for some of them, whether or not acceleration or the accelerator journey decision makes sense, right? So sometimes that conversation is about Techstars, sometimes it's about YC. And I think the way that we frame the discussion that we have internally at First Check Africa
is that my internet or?
See, now I'm not sure. Is that me or is that... I don't know if it's me or I'm worried now.
Okay, let me be quick. So for instance, right, usually the capital, but we actually find that capital is not the strongest reasons why a lot of founders will join an accelerator. It is some of the things that Tunji already talked about. It is, does this give me some kind of preferential access to an investor network, right, in some way? Does it give me preferential access to mentorship and experiences, whether it's peer-to-peer or whether it's structured programmatic experiences that will be additive to the journey that my startup is in? Will it accelerate, at its core, will it accelerate our journey a little bit better? Does it give us potentially a spotlight? So Tunji made the point about how when the Techstars announcement happened, they got a lot of interest, and some people who had sort of made commitments finally sent in their checks. That's another sort of really valuable benefit of potentially joining an accelerator. Yeah, the learning itself, I guess, but I also find that those peer networks founders tend to value them. And so the way we advise people to think about their acceleration journey is, is there a benefit to me, to Tunji's point, around seeding the equity that I will have to, and taking the dilution that I will have to participate in an accelerator? Is there some benefit in terms of either, evaluation uplift post accelerator that perhaps gives me an advantage over the rest of my peers, a signaling effect by virtue of being associated with the Techstars or a Y Combinator that my peers will not have, an ability to build networks with global investors, with other startups that might be building similar things in other markets that I might be able to learn from, would it potentially help me find access to that co-founder that perhaps I've been missing? So in some cases, we have founders who are looking for a technical co-founder, and some accelerators have programs whereby in different programs, some of them are structured so that you can potentially find a partner. I guess overall, my guidance is always, it's important to be super intentional about any decision as a founder, but in particular, the accelerator journey. The accelerator journey is not for every founder. There are many startups that have built global unicorns that were never part of an accelerator. The flip side is there are many that did, and they have done, right? So it is important that ultimately, as a founder, I think you establish a framework, you establish a bunch of questions that keep you honest on the why of your accelerator. And that also, of course, helps you decide whether you're potentially a YC founder or potentially a Techstars founder. The final thing is, I would say, and it's a common theme, I think, across some of the things we've been talking about today, is talk to other founders. So talk to, if you really want to do YC, talk to the founders that have been into YC and talk about what their journey has been, what their experience is. Did they get the things, why did they do it? Did they get that benefit? Talk to the Techstars founders and sort of make that part of the decision.
Great stuff. Thank you so much, Ilaho. So the accelerator journey may not be for everyone, but if you want to get into it, talk to others that have been through the experience. Find out, please jump in. What's your take on the accelerator journey? How do you see things in that?
Well, I mean, I think there's some accelerators that are exceptional. So we actually prepare founders to go to YC, because YC is the best accelerator program in the world. And then we recommend founders to others. I think they're very helpful for helping you get into a rhythm with your product, and also helping you to be put in front of investors. What is critical, though, for a lot of people who go to accelerators is just to keep in mind that, just because you go to an accelerator doesn't mean you're going to be a successful company. So you have to actually build a company, and for the most part, think about an accelerator as just enabling you access, right? So, just think about it like school. Just because you went to a good school doesn't mean you're going to be successful in life. If you don't study and learn in the school, don't do the hard work to build a career, doesn't matter whether you went to Harvard, you could still fail. So I think a lot of people have a lot of invincibility around their accelerator experience, but I think it's just a pathway. It doesn't mean it's not necessary all the time, and it's not a guarantee of success either.
Thank you, E. Dr. Olbra, I'm not sure if you jumped in early on the accelerator conversation, but if you haven't already, go right ahead, please.
I think most of the things about accelerators have been said. I think the primary thing that all the panelists have said is try to get into a tier 1 accelerator. I think the game with accelerators is really tier 1 or the rest, unless you're building a very specialist business. So if you're in biotech, they're specialist biotech accelerators. They're quite specialized accelerators for certain industries. But if you're not building a super specialized startup, then there are really only 4 or 5 accelerators. I think red flags, we've had good experiences with Techstars, with YC. Shortly after we invested in Paystack, it got into YC, and that was, a good thing for Paystack. We've invested in Helium Health. They are also YC as well. We've invested in Life Stores. They are post-textiles. So there's been good accelerator stories. Most of the bad accelerator stories have really come from the tier 2 and 3 accelerators, where they take large amount of equity. Some of them can be quite predatory. The government-owned accelerators especially tend to take a lot of time and don't necessarily give an upside. So we had one that went into one, developed world countries, government startup. They took a huge amount of equity, basically added no value. So that was, and took a huge amount of time away from the company. Because remember, you're not working at full throttle when you're in an accelerator. So when you have like a 6-month accelerator and you've got to move to a different country and you've got to stay there, then you're not like meeting customers usually, right? So that you have to bear in mind that it can take you away from the core business sometimes. I think, for expansion to other markets, one of our portfolio companies, for instance, wanted to go into Europe, and they applied for an accelerator within the country that they wanted to expand into, and that has been a huge success. And they've built, a company with the golden formula, paying salaries in Naira and earning euros. So they've been able to expand across Europe, and that was a very successful strategy for them. Elo and E has already mentioned the type of investor networks that you can become connected to through accelerators. Specialism and focus I've already mentioned, but I'll go back to actually the first point I made when I was sort of giving the context, which is what you really want to achieve. And I think that so many people come into this journey without knowing exactly what they want to achieve. So what do you really, really want to achieve out of the accelerator? What do you really want to achieve out of the business? What do you really want to achieve out of life? And once you ask yourself sort of those 3 golden questions, they'll kind of like guide your decisions as to whether you decide to go into an accelerator or not. But like Inyi said, it's not a guarantee. And plenty of companies that got into YC we don't hear about anymore and are not functioning. And plenty of companies that have not gotten into YC still become unicorns.
Thank you, Dr. Ola Brown. Tunji, let me come back to you. Now back on the matter of business growth and sustaining value. Hope everybody can hear me. Tunji, in what ways do startups typically lean on investors for support that is possibly underserved, you think?
At least in our own journey, it's been just a person to talk to. Because one of the things you then, pretty much realize a lot of the time, and this, of course, you can't, I don't think you have this a lot with the VCs, but at least with the angels that we've dealt with, you have, because it's a lonely, very lonely road. It's a road that you are going to get smacked down a lot of the time, and you're just going to have to, need somebody to be able to talk to. Because I mean, we're in an industry where people don't share their struggles, and sharing your struggles is also seen as a sign of weakness, and you just need somebody to be able to bear the entire conversations with. And I think that is one place that I've critically seen that. But in the other area is in just network. I mean, it's unbelievable the number of people we've been able to speak through one of our angel investors. It's it's literally unbelievable. It's like, when I think Aloha was speaking about sending investor reports. And one of the things we do with our investor report is we put our asks at the bottom, things we're looking to do and things that we're just finding struggles with, And every single week, because we do ours weekly, every single week is like, he always has the plug. He's like, all right, this is this person, I'm like, who is this guy? It's amazing how much people, he's plugged into, and I think, I don't know, I'm not sure you can tell this before the person enters your business, but you really need those kind of people. You just want to meet, instead of, talking to the head of marketing in another company, you want just direct access to the CEO, and somebody can do a direct link between you and them. and then the conversation is more high level than it is, and then you can be able to structure a better deal between both companies. There is a particular area in our business that we just did not have the capacity for. And I spoke to, I put in an ask, and I was like, if we could get this component into our business, it would dramatically increase our capacity. I don't want to use the 10x thing because, I'm not sure founders like it much, but it will do that. And, it was a simple intro. The other guys were like, we've been looking for a business like yours. And basically what we've been able to form is something unbelievable. And I'm thinking to myself, I couldn't have done this by myself. I have a network, a small network, right? But this guy's network has really, really been able to, significantly amplify what we are able to do. So the money was great. The money was good. The money was useful. But I think in hindsight right now, if he, never do this, by the way, never, ever do this for all the founders that are listening. If he had come in and said at the time, I don't have money, but I'll give you my contacts, maybe we would have considered it. But please, for everybody listening, never ever do this. Don't ever ever do it. I repeat again, never ever do it. But I mean, his network has been invaluable to the company. I can tell you, if anything you see in terms of announcements going forward, I would like to claim glory for all of it. But, I can say, and I can tell everybody now that there is somebody behind, helping those connections happen.
Thanks, Tunji. All right, we're coming to the end of this, but I quickly want to get everyone's thoughts on exit strategy. Eloho, let me come to you. Tunji, again, thank you. I hope everyone can hear me clearly. Eloho, how important is an exit strategy for our investor? Briefly.
You don't, you only make a return if there is an exit, right? So there are a bunch of potential outcomes. The startup fails, the startup doesn't deliver on its growth objectives, the startup grows really, really quickly, and ultimately you only make a return if, in the latter of those two, depending on having an exit strategy, one, having an exit strategy that the founders are aligned with, two. So one question that we always ask founders before we invest is, how do you anticipate that we will make a return? And you'll be surprised that sometimes founders haven't given that question.
Thank you, Elo. What's your take on the exit strategy for investors and how important that is? Briefly.
Yeah, I mean, my mindset has always been that growth is the exit. So long as the company continues to grow, there will always be exit opportunities. And exit opportunities differ by stage. The reality for investors, particularly small, early stage investors in Nigeria, is that even by virtue of the laws, you're incentivized to exit a company within 5 years because you have zero capital gains. And you also, you're typically exempt for capital gains for stock, but even without those exemptions, you still have zero capital gains if you exit within 5 years. So your timelines tend to be short, and so you tend to target secondaries as an exit strategy in the earlier stages. And if the company is growing, then growth investors can pick that up. However, even as you scale the business, it's also very important for you to also continue along those lines. So thinking carefully about exit strategy from the point of view of, you've exited the company. Do you need to or maybe you maintain a holding? How can you support the company for acquisitions? How can you support the company for mergers? How can you support the company to IPO? These are all very active opportunities and strategies for exit. But the primary one that we rely on, at least in our firm, given that we have a 5-year return, 5 to 7 year return horizon, is secondaries.
Thank you so much. Dr. Ola Brown, you want to jump in there quickly if you can on the exit strategy from your view?
So I agree. It's just something important for everybody to think about, like how is this investor going to exit? Or, in the case of angel investments and some other types of funding, because I don't want to limit this to VC, how am I going to pay dividends? And dividends are actually becoming more common in our space, as it's difficult to get. Some people want to stay in for longer. For example, some types of investors want to stay in for longer, not every company actually eventually scales, but it doesn't fail. So in terms of strategic acquisitions, obviously we exited Paystack by strategic acquisition. We've had our second exit now by strategic acquisition, and they're local and institutional, local and international strategic acquirers. Obviously Paystack had an international strategic acquirer, and our other exit had a local acquirer. It was a local acquisition, and your investors can help you with these acquisitions. So one of the people that we were actually on the cap table with, we started discussing about it and they decided to acquire the company. So that's sort of one way of exit. The other is public markets. Because of the liquidity problems on the Nigerian Stock Exchange, very few tech companies, I think just the Computer Warehouse Group was able to exit through that way, but that might become something more common going into the future, particularly if the laws change around who can, how much or what the laws are around who invest on the Nigerian Stock Exchange. But definitely the Jumia, IHS, people that invested in those kind of companies exited through foreign stock exchanges. There's also the secondary market. We're about to exit another one of our investments through the secondary market, and that's when obviously we've invested at seed and somebody else comes and invests at Series A. So that's another way that investors can exit. And then I'd like to speak more about dividends, but that's a more complex conversation. Maybe at another point we'll speak more about dividends. But sometimes a company just doesn't scale the way that we think it's going to scale, but they're making a lot of cash. And you know, in that case, there could be a dividends-based strategy with perhaps a longer exit.
Thank you so much, Dr. Brown. We actually now have to we are in Q&A now. Thank you all so much to our panelists for great insights on this. Hope everybody can hear me clearly. I'm going to jump straight into the Q&A from Joseph. This is at E. It says, E, you have a track record of investing in fintechs. What's your take on non-technical core teams?
I think it's dependent on the market that you're going for. Sometimes, you know, in a space, if you need certain kinds of expertise that's not necessarily software related, a non-technical core team could be acceptable, right? Because the business doesn't rise and fall necessarily on the technical expertise. But if you're building a technology company or something that's primarily a technology company, that expectation is different. But I think in general, usually it's a good idea to have one or two technical people in your founding team. But you know, if you're building a startup that leverages technology but doesn't necessarily isn't in technology in a pure sense, you know, you can get a pass.
Thank you so much for that. Okay, there's a question here. I'll throw this to Tunji. This is from Akpan Victor. Says, we got an offer from an accelerator program and they're offering to train us within 3 months on venture building for 5% equity in our business. After my due diligence on them, I discovered they did not have a strong network of investors for fundraising. Is this a good deal? Tunji, what do you think?
I don't know who the accelerator is, but I would say turn it down. There needs to be something, a clear value add of the accelerator to your business. I mean, train you of what? I mean, it must be clear, very, very clear. So again, Techstars, I spoke to other Techstar, ex-Techstar founders, and there are many in Nigeria. I spoke to a lot of them. In fact, one of them was invested in our angel round. So there were clear deliverables. They were able to tell me, this is what you should do. This is how you take advantage of it. Because even the truth about most accelerators is what you give to, is what you put in that you will get out of it. So I got a lot of, you know, advice at the beginning before we went into it. Then when it is about training, I'm not really sure how that really helps, but maybe it helps for your business. But I'll say don't take it. There's a lot more accelerators around that can give you a lot more for that 5%.
Thank you, Tunji. Thank you, Tunji. Great stuff. This is from Adenike. Aloha, I'll throw this at you. Said the panelists have pointed out business differences and how their approach is different. I'm in the food and beverage industry, which hasn't really been talked about here, what are the core metrics you think I should concentrate on for scaling? I know, Aloha, maybe you're not in food and beverage, but can you take a stab? I don't know if you want to take a stab at that for.
So I'm in food. So I do private equities in non-tech companies as well. And we just invested in a female-founded tech company, a female-founded food company called Real Fruit that does manufacturing. But this is a traditional company. And I tried to make the discussion wide, so it wasn't just tech. But somehow I feel like anybody that is just running a non-tech company, somehow like the conversation hasn't been as wide for them in terms of what metrics they should be looking at and how they should. If you're running a factory, that is not, you're just producing food and you're selling to ShopRite or a supermarket, then how do you go about that? So we recently made an investment like that, and that's under our private equity portfolio. And the valuation for these type of companies is generally different. If it's not a tech kind of beverage company, then the valuation is different and the journey is different as well. So these are the type of companies that during the due diligence stage, we'd be looking at different metrics. We'd be looking at opportunity, operational efficiency. We'd be looking closely at the market for sales, the sales channels and the distribution, both in Nigeria, across West Africa, and internationally. And we'd be looking at perhaps a mix of potential acquisition strategy. We'd be looking at potential strategic acquisitions that could happen down the line if the founder is open to that. But we might also be looking at a non-exit focused strategy that pays dividends. Because for these large manufacturing companies, they usually grow. They're usually a bit slower growing, and then also people not necessarily slower growing. Sorry, I said they're not. They don't scale in the way that traditional tech companies scale, and that means that from an investor perspective, the conversation that we've had, and I'm sorry to anybody that runs a traditional manufacturing business, the conversation that we had may not be 100% applicable to a manufacturing business. I invested into one is a drug and beverage company and one is just a food company. So what investors are looking for in that is the level of operational expertise in terms of your manufacturing value chain. And 100%, the most important thing is the distribution and how the company can assist you with distribution. So we've invested in a logistics company, and we usually look at the logistics and say, can this logistics company help them with distribution to expand across the country? We also have relationships with international supermarkets, for instance. So when we invested in our manufacturing companies, we're always looking at, okay, how can we build your relationships with these supermarkets in Europe, supermarkets in America, to get that dollar income and to raise the amount of dollar income. I talked about the magic formula earlier. So to raise the amount and things like airlines, for instance, airline customers, people that buy large amounts of food and beverage. Also, how can we assist that company primarily with distribution? But generally speaking, we're looking at longer term investments, different valuations, and perhaps maybe a dividend strategy, perhaps a different type of exit strategy. But for the manufacturing businesses, I think it's a slightly different conversation I think that we can have when we're talking about traditional businesses that are not tech first businesses. And I tried to broaden the conversation, but I think it's difficult to have those two conversations at the same time.
Fair enough, Dr. Ola Brown, but I see you emphasizing a lot on distribution. So Adenike, I hope that answers your question. There are lots of emphasis there. Finally, okay, Simon, Dr. Eloho, let me come to you on this question from Simon, because we're over time. But Eloho, would you prefer a razor sharp focused business or founder, or might focus be diluted if you start making the founder think of pivoting possibilities as a sign of resilience? Eloho, what do you think?
But if you're asking me if I like a razor focused founder, I think I understand. Razor focused on a particular idea or a particular market versus considering pivots. I always kind of frame what I look for in founders. I and again, if we're talking about pivots, you're quite an early stage founder, right? So I always frame what I'm looking for as, I would say, strong ideas loosely held. So there's, you use the point mission focused founder. There's a particular problem that I'm trying to solve, but there's an idea maze that I'm navigating, and there's a bunch of different ways that I might approach solving that problem. So I'm going to make a bunch of tactical decisions around how I get there. I'm going to figure out what segments of the market are profitable. I'm going to figure out what ways of acquiring a customer are profitable. I'm going to learn about my customer. Some of them want to engage with me via an app. Some of them don't. Some of them I need to build some kind of iOS app for, depending on where I'm going. Some I'm happy to use a web app. And I think those kinds of decisions around, are there different, there's a big market opportunity. There are different points of the market, different segments of the market that will be more profitable and more readily addressable. And am I kind of on a journey to build a business that is big, strong, resilient within that milieu? Or am I insisting that this is kind of what I want to do, and regardless of kind of what the market feedback is, I'm going there? I think that latter type of entrepreneur is a little bit, is less attractive to me than if the first is a the first to me is a razor focused entrepreneur, actually, because they're focused on delivering a solution, not necessarily being married to the path and learning from the market with regards to how they get there. I pivots as long as they are based on market feedback, as long as they are tactical, as long as they are based on a specific trying to deliver a specific solution. I'm not afraid of pivots. So to me, razor focused entrepreneur means somebody who is super insightful about the market that they're addressing, the problem they're trying to solve, not necessarily somebody who does not pivot.
Thank you so much, Eloho. And I think that's as much as we can take, because we're well over time, but I wanted to make sure we had one answer from each of the panelists from our audience. And I think that there will be a YouTube link available, because I see some people ask for a YouTube link as well. Tayo, I think, does that bring us, I think, to the end of this? I want to thank Eloho Omame, co-founder of First Check, Tunji Andrews, co-founder of Awaba, Dr. Ola Brown, Line Doctors Healthcare Investment Company, and of course, Ian Aboyeji, founder and general partner of the Future Africa. You guys you've been great. This has been very, very insightful. Hope to do more of these in the future. And of course, our thanks to Nairametrics for putting this all together. All our participants, follow Nairametrics, Twitter, Instagram, everywhere, nairametrics.com. Tayo, does that bring us? I guess we can round up at this point.
Yes, thank you so much, Ross. It was really insightful conversation with a lot of nuggets. Thank you so much to all the panelists. Thank you so much to all the participants for joining. I mean, I certainly learned a lot about scaling the business, growing, and obviously sustaining value. Don't forget, you can get the recording on our YouTube channel up in a couple of days. And don't forget to always follow Nairametrics. We love to do conversations like this and basically create content all around business, finance, and economy in Nigeria and Africa as a whole. Thank you so much, guys, and have a very great weekend ahead.
All right, take care.